Hey, I hope you're doing well. Today I'll be talking about CoreWeave and anything you would potentially need to know if you would like to participate in the IPO. Before I get into all the details, let me explain what CoreWeave does. CoreWeave operates a GPU-based servers. These are different from servers that are operated by the likes of Amazon or Microsoft, which are primarily based on CPUs. That is their distinct moat, which is they are able to provide GPU-based servers. All right, now let's talk about their competitive advantages, which are listed in their S1. So the first one is we are purpose-built for AI. This is in other words, basically stating that they're able to purchase GPUs and they focus on that, which is the second point as well, which is they are able to get performant GPU clusters assembled. I mean, wow, isn't that an amazing advantage? That would be akin to, let's say, not a dealership, but a car company buying cars and saying their competitive advantage is they buy cars. Not very good. Next thing I do think is a competitive advantage, and that is they operate at scale. I mean, they have 250,000 GPUs, which is quite a bit. However, when a competitor like Microsoft or Amazon comes in and they start buying GPUs as well and start assembling large clusters as well, is that really a competitive advantage when you're dealing with trillion-dollar companies? I really doubt it. I really doubt it. Next one is, I got a pretty good chuckle out of me. I found it pretty funny, is that they state that they can secure power, and that is their competitive advantage. Imagine stating and going public and saying that your competitive advantage is you have access to electricity. I mean, so does 80% of the world, 80 to 90% of the world. I mean, that is pretty funny. Sure, they need a lot of electricity, and I'm kind of exaggerating, but still, come on. I mean, this is not a very good competitive advantage. Next one is also quite funny. They can finance. They have an ability to uniquely finance. I mean, sure. I mean, getting a loan is a competitive advantage now, apparently. This one is a good one. I mean, they do have good relationships with other providers like NVIDIA. I mean, NVIDIA does own 5% of CoreWeave. So that is true. They do have pretty strong relationships. However, this is also a detriment because about 77% of their revenue comes from 3 customers. I mean, talk about diversification, right? So that one is not very good. However, I do want to say they do have a potential opportunity here to where right now they're an AI-centric company, so most of their customers are centered around AI, and as they've stated, AI labs and AI enterprises. However, they can expand to other industries, like they've stated right here, like banks, high-frequency trading, pharmaceutical companies. I do think that is an interesting opportunity in both diversifying their revenue as well as potentially getting higher profits, because now they're kind of a unique brand where, like, oh, they're the first entrant, they're a large player, and now that kind of explains their competitive advantages because they're kind of a first mover. So that's why they've stated like electricity and stuff like that. Although it is pretty funny that a public company says their competitive advantage is they can get electricity and buy GPUs and get access to debt. But whatever. Now I want to talk about their income statement. Not exactly their income statement, but it does the job at explaining why I don't really like this company. As you can see, they're going public as soon as they're able to get operating income. Sure, the operating income is not bad at $324 million out of $2 billion in revenue in a year. However, they are still, losing money on EBITDA. They're a money-losing company. Still, $863 million in 2024. I mean, sure, they're cranking out operating income. However, they're still losing money on net. And this is primarily because of the increase in their infrastructure. They're spending a lot on acquiring more GPUs, building out new data centers, which could have an increase in revenue growth in the future. However, this brings me to my next point, is that they stated that their GPUs have a lifespan of 6 years. They completely depreciate their GPUs in 6 years. And yeah, I mean, the revenue growth looks absolutely amazing, where they were generating 16 round up, $16 million in 2022, and now they're generating $2 billion in 2024. The revenue growth is amazing. However, the numbers are not that great. I mean, yeah, they're losing more money now. As you can see, the operating margins are now 17%, which are not bad. However, if you consider this as an AI company, 17% operating income is not great. It's not even great as a general company. The adjusted net margins have improved significantly, but this is due to scale and also operating leverage. But whatever, that is besides the point, since right now it's still losing money at a 3%. And I do think they can get profitable this year. But the question is about long term. 3, 4, 5 years. If you think that GPUs are going to be more common and more readily available, then what is CoreWeave's advantage here? Their assets are they're going to be depreciated in 6 years, so they have to completely repurchase new ones, as they have stated, primarily because their customers expect the best GPUs to be available. And if they are not available, well, then they're not going to purchase compute from CoreWeave. They will find someone else. And that is the issue here. CoreWeave has no competitive advantage except gaining access to GPUs that are not readily available at the moment. However, when that changes, it's going to be a bad day for CoreWeave. CoreWeave's margins are bad now. I mean, shoot, imagine the margins they will have when Microsoft, Amazon, Google enter the GPU server market. When GPUs are going to be readily available, we think margins better now. They're going to be even worse. I mean, this might be one of those companies that I won't be surprised to see bankrupt. I'm not saying they are going towards bankruptcy. There's no competitive advantage if you look at the company holistically. There's nothing special to CoreWeave. They don't really have any special software. Sure, they have their own spin on like Kubernetes and stuff like that, but that is not special. They're not special. This is not a special company. You can see this with the margins. I mean, when you're an AI company and you don't have phenomenal margins, this brings up a lot of questions. These margins are not even phenomenal as a general company. Like, the net income margins are not great. They're still expanding. Sure, the revenue growth might be exceptional in the next years, but it's all financed. And if you look even beneath that, when the underlying assets are depreciating at in 6 years at a pretty staggering velocity, and at the same time it is being financed, it's a recipe for disaster, in my opinion. And let's take a look at their balance sheet as well, because it's not pretty either. Yeah, if we take a look at the balance sheet, we can already see some problems. But, they're going public, so this is not that much of an issue. First of all, their current ratio is terrible. As you can see, they have total current liabilities of nearly $5 billion, but total current assets of $2 billion. That is not a very good ratio. You usually want a ratio above 1. This is significantly below 1. And if we take a look at the assets, what do we see if we avoid all the others and we focus on 2 of these right here? The $2.6 billion in operating leases and $2 billion in property and plant and equipment. Sorry, it's just property and equipment. Let's assume that about half of $12 billion, half of it is GPUs. In 6 years, those GPUs are going to be completely depreciated. That is, on accounting terms, they will be worthless unless, they have some intrinsic value, which they do have in 6 years. And I do think they will be higher than expected, so not exactly fully depreciated in 6 years. In accounting terms, yes, they will be fully depreciated. And that doesn't mean they won't be functionalist. Those GPUs will still probably make money unless they, like they've said, will replace them with new GPUs, in which they might get a gain from selling that because they fully depreciated it. That could be a future benefit. However, this current ratio does not look good. They have accumulated a lot of debt, a lot of debt, if we can take a look right here. So now if we imagine that about 6 billion in property and equipment will be lost due to depreciation in 6 years, and let's imagine these numbers stay the same, okay? They don't accumulate more debt. They do not accumulate more assets. However, they will obviously accumulate more assets because they're able to generate revenue, and hopefully they can get profit. But let's say we hold that still and we don't pay off debt either. In that case, we can see that the total assets will decline below the total liabilities. I am extrapolating a little bit, but that is because I'm trying to show you the potential risk in this one because of the inherent problems in their business, because they keep buying GPUs that are inevitably going to be worthless. If you imagine purchasing a computer in the 2000s, well, let's not do that. Let's use Apple's computers as an example. Anyone remember the Intel MacBook Airs? Those are so much worse than the new M1s. And those, the Intel computer was in 2019, so that would be actually exactly 6 years ago. So, and the Intel MacBook Airs are worthless. You go on eBay, they are worthless. The trade-in value for even the Pros, the MacBook Pros with Intel chips are worthless compared to the new MacBook Airs right now. That is the example of the GPUs and the innovation within GPUs that is happening right now. That the GPUs in 6 years that they are purchasing right now might become worthless, kind of akin to the Intel MacBook Airs, because the new M4 chips in the MacBook Airs are 23 times better than the chips used in the 2019 MacBook Airs. That is just an example of what kind of damage that could be done to these underlying assets that are being financed by debt. I mean, this is a recipe for disaster if we take a look at this. And that about wraps it up. Not much else to say about this one. And I'm really sorry to going in so hard on this one. But the reason I'm heavily criticizing this one is because I like to find opportunities that generate value, that create value for the investor, that in the future they will actually make money. This one is the opposite. I look at it and I look the fundamentals. I look the business around holistically, entirely, in its entirety. It makes me worry because this will likely, the antithesis of creating value, it will have so much value destruction purely because of the broken business it is. I personally will not participate, as I've said in the beginning of the video. I can't give any recommendations, nor will I, but I just advise you to be a bit more careful with this one. And if you enjoyed this one, please like, share with anyone who might find this helpful, and please subscribe because you don't want to miss out on a potential opportunity that's going to come your way. And yeah, have a good one.